Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you a brief market summary for the week ending August 23rd, 2024, as well as trading levels in the major market indexes for the upcoming week of August 26th. We'll take a look at the SPY, the triple Qs, and the IWM ETF, and then we'll also take a look at the TLT ETF for the bonds. Before I go on here, the usual disclaimer, Precision Trading Labs, we are neither money managers nor financial advisors. Nothing I'm about to present is investment advice, and everything I'm about to show you here is for information and educational purposes only. So let's take a look at the SPY here. Of course, this is the ETF of the S&P 500. And so this is a daily chart. Also, before I go on here, I'm actually battling some laryngitis here. So if my voice cracks a little here, forgive me. So anyway, this is a daily chart of the SPY. And so we had hit an all-time high in mid-July over here. And so at that point, though, notice that price came up, consolidated, and then notice that there were these three red candles here, all of which were pretty bearish, and that was, of course, preceded by that gap there. Okay, so right here, if we think of this region right here, price had come up, consolidated, and then dropped out of there, and those are those three candles that I just highlighted. And so if we're looking over here, we can think of that what occurred here as an exhaustion of sellers. Within this range here, buyers and sellers were more or less in agreement within this $3 range, and then all of a sudden there was an exhaustion of buyers here. No one was willing to buy anymore. Okay, and so if we think of what was going on in this region here, if we think of the shares that are offered up by sellers, we can think of that as the supply of shares, okay? And if we think of the shares that are acquired by buyers, we can think of that as the demand for shares. And so within this region, supply and demand are in balance. And then once this exhaustion of buyers occurs, supply and demand go out of balance. And in fact, up here, there is no longer any demand, only supply. And so consequently, we think of this region as a supply zone. And so when price returns back to a supply zone, quite often that there is still untapped selling pressure that is waiting to be taken advantage of. And so when price returns to a supply zone, we could express a bearish trade out of that supply zone. And so up here, I have those the various options, the various choices listed. So of course, the obvious thing out of a supply zone, one could sell short a stock, so we would short the SPY. One could, of course, could also buy a put on the SPY. One could also do a bear put vertical debit spread out of that. And then, of course, one could also collect premium by doing a bear call vertical credit spread. And so those would all be different ways one could express a trade out of this supply zone. So in fact, what we did here on Wednesday was we actually, a bunch of us actually bought puts here. And so we held that position on Wednesday and Thursday. And then we actually closed the position yesterday after a pretty successful trade. And frankly, we would have, under normal circumstances, held this trade into today, except for the fact that here's the economic calendar here. And if you notice right here, for whatever reason, today was the day that everybody at the Federal Reserve and their brother was going to be talking today. So Chairman Powell is talking today, as well as four other members or Fed governors of the FOMC. They were all talking today. And so we just thought we would just be cautious because we didn't know what they were going to say today. And so we just figured, you know what, we would just cut the position short yesterday and just let them talk today. So that's what we did. So anyway, that was the trade with the SPY. So now if we look over, we look here further, there are some other trading zones that we're actually waiting on here. And so here's where we're about to close today. And so right here, below here, if we actually look at this and we turn this into a 1 hour chart, we will now see, hopefully that'll roll over there. There we go. Right here, we actually have in here, this is a 1 hour demand zone here. And in a sense, it's the same narrative that I just told you about the supply zone, except in reverse. Right here, we had this consolidation area. And then notice right there, price comes out with a great deal of energy with a very bullish candle there. Another one, then there's a little consolidation there, and then notice then there's that run up of pretty bullish price action there. And so right here, supply and demand were in balance, and then right here we had an exhaustion of sellers. Okay, no one was willing to sell here anymore, and so the same narrative that I told you before applies here, except in reverse, of course. We're now waiting for price to return here in order to express a bullish trade out of that 1 hour demand zone here. And so if we look over here, here's of course how we would express the bullish trade. You can buy the stock, buy a call, and of course one could also sell a bull put vertical credit spread in order to collect premium. And so right there, there's that little 1 hour demand zone there on the daily chart here. And so we think of that as more of an intraday, either an intraday play or kind of really a hit and run kind of thing, where we would be in either on an intraday basis or perhaps maybe a 1 day swing trade. Okay, further down below here, though, this is a daily demand zone here, and so this is a rally base and then a rally out of that, and then you can see that's actually a pretty juicy move there. So when price returns to this region, this would be an area where we would expect that we could have a high probability bullish trade in the manner that I just showed you before. And so the way the trade would work would be, this would be our entry right here at around 534.5. Okay, we would place our stop just a bit behind this zone here. Okay, and then at that point, then that identifies our risk. Okay, so between 527, let's say, in 80 and 534, so that's about a 6.5 point range there. But then this would represent our 1 unit of risk here. So each rung on the ladder here represents 1 unit of risk. So right here, if you made it up to here and got a bounce, that would be a 1-to-1 trade. That would be a 2-to-1 trade. That would be a 3-to-1 trade. So that's how essentially we construct our trades there. So in terms of the quality zone there, there's that 1 hour demand zone there, and that's about 1% down from where we're about to close now. And then that better demand zone on the daily chart, that's about 4% down. So we'll wait to see what happens early next week. So essentially, we've got a couple of buy points laid out here. We're kind of done above here. This is the all-time high. So we have no fresh supply to push off of anymore. So really, there's nowhere where we would be looking to short in the short term there. So that's the story with the SPY. If we take a look at the triple Qs, which of course is the ETF of the Nasdaq, right here we have, so as it pops up there. So right here, here's that all-time high. The all-time high on the Nasdaq was hit on the 9th of July. Okay, and so and in fact, this was that area. This was that shot down that we took about 2 or 3 weeks ago, and that was kind of noteworthy because that actually put us in the short term into correction territory. Okay, that move down from July 9th, which was right there, that pushed us down about 13% or so over here, and that was actually sorry about that. It seems the market is just closed. So right there, there's that 13% move from down there, and that actually made some major headlines on CNBC and Bloomberg, because technically we had gone into correction territory. And of course, as soon as that happened, we pretty much, clawed back a good 2/3 of that. So right here, this is where we closed today. So above here, unlike the SPY, we actually do have a supply zone above here. This is a drop-based drop formation. Notice that price consolidates there, and then we have that gap, and then of course that big swoon that occurred that put us into correction territory. So right here, we had the exhaustion of buyers that I talked about before. And so up here, about 3% above where we are now, we have not been back there since. So in fact, when price returns to that region, what we expect is that we will express a bearish trade up there. So that's about 3% above where we are now. And then below here, we actually have a quality demand zone down here, and that's about the same distance away, 3% down from where we are, where we just closed. So 3% above, 3% below. So these are two quality zones to express a bullish trade here and a bearish trade above there. Okay, so that's the story with the Qs. We take a look at the Russell. Right here, here's where we closed here. And then this is actually a fair distance down, but about 5.5%, 6% down here. We actually have a demand zone sitting there again on the daily chart here, but that's about 5.5% down. So obviously that's a fair distance down, but that's really, I think, where we would be looking for a trade there. And then this is actually a trade that we had about 2 weeks or so ago. We had actually had this nice trade off of this supply zone, and that supply zone actually got created believe it or not, a couple of years before that. We had not been back here since November of 2021. And in fact, if we just go back here quickly, you'll see right there, the origin of that gap. That was actually a nice supply zone there. So in fact, that was the basis for a good trade, good trade. And so most of our subscribers here basically just pretty much just bought puts right here and kind of closed them out roughly down somewhere around down here. So that was actually a nice move here. They rode that from about 228 down to about 207, give or take. So that was the story with the Russell. And then the last thing we'll take a look at here are is the ETF, the TLT ETF. This is the ETF of the longer duration bonds, 20 years and beyond in duration. So that's what we're looking at here. We're looking at the daily chart here. Right down here, there was a lower time frame demand zone here in the 1 hour chart. So if I flip over to that, okay, so right here, this was actually an area where we had a nice trade earlier this week. Okay, we actually cut, and again we cut that short going into today, right at the start of today, because of the fact that the Fed governors were talking here. So this is what that trade looked like, though. This was the entry. Right there, there was the stop out point, and then right here, this was the exit right here. So we actually got a 3-to-1 trade, which essentially was we picked up about 70 cents or so on the TLT. So that's the story with that. In terms of what might be on tap for next week, there's really nothing here, okay, because of the fact that this is actually not a fresh zone anymore. Under normal circumstances, we would have looked to that as a potential area to express a bearish trade. The problem with that, though, is that right here, there was a lot of trading that went on. And in fact, this was actually an area of supply right there. And so as a result, this is no longer a fresh level, because this is already this level was already tested, and the supply was probably chewed up by that incursion there. So there's really nothing in the short term that we're looking at on the TLT. So at any rate, that's what I got. This is Mitch Firestone with Precision Trading Labs. Thank you for the privilege of your time, and I will see you next time.